Well, we've made it. Week 10. Today I'll talk about our final class and then I'll do a wrap up of what we've covered in the course. Our final class is on credit analysis. This uses a similar set of skills as equity analysis, but without an explicit focus on valuation. We're more concerned with the capacity of our firm to pay back its borrowings. This is going to be a key issue for a great deal of firms all around the world, given the impact of inflation and the rise in borrowing costs. First up, it's worth noting that the credit market is an order of magnitude larger than the equity market if we measure on turnover. This is despite the equities market getting all the love in the business media. In the same way that our fundamental analysis for equities takes place in a broader investing context, so too does the use of financial statements within a credit analysis setting. For example, if you're in the position of a potential lender, you'll be wanting to consider what the loan is going to be used for and match that to the type of loan, the amount, and the time period of the loan. You'll want to try to assess the borrower's capacity to repay the loan, and to do that be calculating its current capacity to repay and use forecasts in determining the future capacity to repay. You'd then negotiate the specific terms of the loan should one be offered. We typically think of credit-focused ratios in terms of a firm's ability to repay its obligations in the short term, and then those that look at the ability to pay long-term debts. We call these liquidity ratios and solvency ratios respectively. Liquidity focusing on the short term and solvency on the long term. An important fundamental intermediary are the credit rating agencies. These firms provide information on the overall creditworthiness of firms and also rate specific debt issuances. The three big rating agencies are S&P, Moody's and Fitch. The credit ratings agencies have come under sustained criticism from the dot-com bubble and bust at the start of this century through to the financial crisis of 2007 and 2008 and more recently. And it takes two broad themes. First, that the ratings are on average too high, and secondly, that the ratings agencies don't change quickly enough in the face of bad news. The main agencies have different scales, but the important cutoff point is the difference between what is classified as investment grade and non-investment grade or in speculative grade. This is also known as kind of the junk bonds or junk ratings. The ratings is somewhat of a black box process. We don't know exactly how they're determined, but we do know what sort of factors are associated with different credit ratings. Another important use of financial statement information in a credit sense is trying to predict bankruptcy. Prediction models typically use some combination of financial statement ratios. The most popular of these is the Altman Z-score. These models have been refined over time, but still are not great at predicting distress beyond about 12 months. We'll have a look at why that might be the case. So, let's do a quick wrap up of what I hope you've learned from the course this term. First and foremost, you have to understand the business. That's key. The better you know what your business is doing and the industry conditions under which it's doing it, the better all of your subsequent analysis will be. Think about what the main transactions are, what the key risks and the key opportunities are. Don't be beholden to any specific analysis tool, but carefully consider what will best allow you to communicate your view of the company's circumstances. Your analysis of the business and its strategy will assist you in your accounting analysis. This step involves you assessing the extent to which the company's financial statements do a good or a bad job of reflecting the underlying economics of the business. This will vary due to the accounting rules and the extent to which those rules give managers discretion. You'll consider the extent to which the firm has incentives to achieve particular financial reporting outcomes. Note that sometimes you'll identify conflicting incentives for firms. You'll use your accounting analysis to determine if you, as an analyst, can adjust the financial statements to better reflect what you think are the underlying economics. You'll then be in a position to undertake your financial or ratio analysis. We've gone through this in a structured way, starting from ROE, which is a summary measure of overall performance. You can also focus on the key ratios that best reflect the risk and performance of your companies. We do this to lead into our final analytical step, prospective analysis or forecasting. We forecast a condensed balance sheet, an income statement, and out of those forecasts come forecasts of free cash flows or residual earnings. We can then use those forecasts in our valuation models or for credit assessment. Of course, once you have your valuation and you compare that to the share price, you'll have to consider the implications of any differences between your assessment of fundamental valuation and prevailing share price. Are the markets wrong or are you wrong? Your view on market efficiency will help you answer that question. Thanks very much for all of your attention, all of your discussion, all of your contributions throughout the term. I hope it's been a useful one for you.